Ever wondered about the differences between JEPI and SPYI? Let's embark on a journey to explore these two remarkable investment tools. JEPI and SPYI are more than just a random assortment of letters. They're ticker symbols representing two distinct investment strategies, each with its unique set of characteristics. Remember to subscribe and comment on what fund you'd like me to review next. JEPI, with its lower expense ratio and more consistent performance, offers a conservative approach to investing. On the other hand, SPYI, with a slightly higher expense ratio but a potential for greater returns, may appeal to those willing to accept a bit more risk. But the differences don't stop there. Even their sources of yield vary. While SPYI generates most of its yield from distributions, JEPI's yield source is a bit more complex. These are just the surface-level distinctions. As we delve deeper, we'll uncover more about their unique performances, risk profiles, and returns. So, stay tuned as we delve deeper into the specifics of JEPI and SPYI. First, let's explore the performance summary of SPYI. SPYI, or the S&P 500 Yardstick Index, has some intriguing aspects to its performance. Starting off, we notice an expense ratio of 0.68%. This means that for every $10,000 invested, $68 go towards the operational cost of the fund. Now let's focus on the balances. If you had started with $10,000 in this fund, you'd have seen it grow to $13,053. This is quite an impressive increase, isn't it? This brings us to the annualized return, or the compound annual growth rate, CAGR. SPYI boasts a CAGR of 19.44%, indicating a strong, consistent growth over time. The standard deviation, which measures the volatility of returns, stands at 8.78%. This suggests a moderate level of risk associated with this investment. In terms of annual performance, SPYI had its best year with an 18.13% return, while its worst year saw a 10.50% return. These figures illustrate the variability in annual returns, but also underline the overall positive performance. The maximum drawdown, or the largest peak-to-trough decline during a specific period, was negative 5.84%. This shows the potential downside risk in a worst-case scenario. Now let's talk about the Sharpe and Sortino ratios. These are risk-adjusted performance metrics, with higher values indicating better returns for the same level of risk. SPYI has a Sharpe ratio of 1.49 and a Sortino ratio of 2.56, both suggesting an efficient risk-reward trade-off. Lastly, it's important to note that the majority of the yield from SPYI comes from distributions, not from any dividend from stock, as the 30-day SEC yield is 0.84%. This means that the returns are primarily from the capital gains and income generated by the fund's investments. That's SPYI in a nutshell. Now let's turn our attention to JEPI. Now, it's time to dissect the performance summary of JEPI. Let's delve into the numbers and see what we can find. JEPI has an expense ratio of 0.35%, which is a measure of what it costs an investment company to operate a mutual fund. An expense ratio of 0.35% is quite low, suggesting that JEPI is a cost-effective investment option. Starting with a balance of $10,000, JEPI ended with a balance of $11,652. This shows a clear growth in value over time, which is always a positive sign for investors. Next, we look at the compound annual growth rate, or CAGR, which sits at 10.73%. This is a useful measure of the yearly growth rate over a period of time. It's important to note that while this figure is lower than that of SPYI, it's still a respectable return. Now onto the standard deviation, a measure of volatility. For JEPI is 7.64%. This is less than that of SPYI, indicating that JEPI might be a less risky investment. The best year for JEPI saw a return of 9.81%, while the worst year saw a return of 6.11%. This shows a smaller range of returns compared to SPYI, which might appeal to more conservative investors. The maximum drawdown, or the largest single drop from peak to bottom in the value of a portfolio, was negative 4.11%. This is less severe than SPYI's max drawdown, further reinforcing JEPI's lower risk profile. The Sharpe ratio, a measure of risk-adjusted return, is 0.71, and the Sortino ratio, which focuses on downside risk, is 1.09. Both these ratios are lower than SPYI's, suggesting that JEPI's returns might not be as impressive when you factor in risk. Lastly, the majority of JEPI's yield is from distributions and not from any dividend from stock, as the 30-day SEC yield is 0.84%. That completes our overview of JEPI, but how do these two compare? Having looked at JEPI and SPYI individually, let's now compare them side by side. JEPI comes with a lower expense ratio of 0.35% compared to SPYI's 0.68%. However, SPYI has shown a higher return over time, ending with $13,053 from a starting balance of $10,000, while JEPI ended with $11,652. From an annualized return perspective, SPYI leads with 19.44% against JEPI's 10.73%. When it comes to risk measures, SPYI has a slightly higher standard deviation, indicating a higher level of volatility. However, it also has a higher Sharpe ratio, which means it provides a better risk-adjusted return. JEPI, on the other hand, has a lower maximum drawdown, which could make it a safer bet during market downturns. So there you have it, JEPI and SPYI, two distinct investment options with their own unique advantages and characteristics.